Good morning, everybody. We are extremely pleased that so many of you were able to actually attend today or are able to attend. We have already 54, 55 participants on this webinar. We test for the first time a new format, which is a webinar. That means that if you have then a question, you can raise your hand or you can send me an email and then I can actually put the question for us. We have a lot to discuss. There are busy times, special times. That's why I would like to start immediately, and it will be recorded like always and pass on to Marcos.
Thank you, Alex. Welcome everybody to this morning webinar. We think it's a very good time to do a conference call on the markets and on the situation due to the Iran war. And we're going to have kind of a lot of contents today. So I'm going to start very quickly on the first slide, slide number 3. So since 2020, it has been amazing. We had the COVID-19 in 2021 and 2020. Then we had the Russia invasion of Ukraine in 22. Then we had the attack of Hamas in 23. Last year, 25, we had the Liberation Day, and this year we have, a war in Iran. So it looks like this is the fourth black swan as from Taleb in 5 years. And, in moments like this, we are really proud and we feel calm about the resilience of our investment philosophy, what, very well we call strategic value, built around the 4Gs, because when you're invested in high quality businesses, good management teams, good balance sheets, and attractive valuations, our portfolios are designed to withstand any crisis. So this is not our idea. This is an idea that was already said by Ben Graham many, many years ago. Our funds are also well diversified, so there's no single factor that can damage the portfolios. This means that we are really calm ahead of what is going on. We will give you our opinion on what is going on, but the message here is, one, portfolios have to be prepared before the crisis begins, and this is a lesson that we learn also from Buffett. And the second, also from Warren Buffett, is that the world has always been uncertain. No? He said this in an interview. In the end, as we were saying, this is the fourth big event in 5 years, and we are still here, and the performance is okay. So moving to the next slide on the Strait of Hormuz, basically our view is consensus. War in Iran can lead to an energy crisis, yes, maybe. And there's 3 things that are relevant here: the duration of the conflict, because basically 15 to 20% of the flows of oil and gas are blocked. Then the damage to oil and gas infrastructures, and we had these bombings 2 days ago that changed a little bit the picture. And finally, the outcome of the war, if it is going to be an invasion or not, or whatever happens. So far, you can see in the chart the countries that are more or less affected. Those obviously that have a positive energy trade are less affected, but in the end, this is going to be binary. Our base case scenario is that the conflict proves short, a couple of months, and ultimately leading to a diplomatic agreement. But this is our base case scenario. In the next slide, you can see what can happen, and the scenario is very binary. On the left-hand side, you can see, so this is the distribution, historical distribution of oil prices, and you can see 2 different distributions. On the left-hand side, you see when the market is well supplied. On the right-hand side, you see when the market is not well supplied or there is a scarcity. So we are slowly moving to the $150 scenario, and it's going to be binary. So we don't have an opinion of this is going to be short or long. Basically, what we think is that now the scenario is binary. Our exposure as SIA funds is good, I would say, initially. 12%, around 12% of the classic is in energy, and this is supporting the performance. And 40% plus of the natural resources. So natural resources doing very well year to date. We'll enter later on. So basically, we are entering the crisis in a good position. And I was saying this before. we were ready. We were ready before. And final word on the kind of top-down view is not only Iran. So we are following closely another two sources of problems or risk. One is private credit. I'm not going to enter in detail. There's a lot of, problems in some of the managers of these private credit funds or markets. And this is a sector which has been untested in stress conditions. These guys, they are unlike banks. They do not set provisions. They do not do mark to market or, very late. They don't have buffers in terms of capital. Also, there is a liquidity issue, so they are vulnerable on outflows, and they have exposures to software. So really, it's a pocket of risk. But we have been reading some papers lately, and the number we get is that the total exposure globally is around $600 billion. It's not really systemic. $600 billion. If you want a systemic risk, take US housing. We are talking about maybe 17 billion. This would be a systemic risk. The private credit looks like a bump, but not a big systemic risk. And then the second thing we are following a lot and trying to understand it is AI. For now, we are probably behind the curve. We only analyze the sector in order to see if we have sectors and companies exposed. And the initial reading is that neither the classic nor the natural resources is exposed to AI. So we don't have software, we don't have really sectors exposed, which is good to see. We will keep learning, we are using it, and we'll keep you updated on that. And I will pass it to Alex. He's going to talk a little bit on indices.
Thanks a lot, Marcos. Of course, maybe if I start with AI, a lot of our companies are taking advantage of AI as well. And these are sometimes oil companies or salmon companies. Now, I found two very interesting charts in the last newsletter from GMO. And look at this chart to the left. You find here the S&P 500, how much percentage-wise are trading with a price-sales ratio above 10. In the year 2000, this ratio hit 30%. We are now at 34%. Now we all know these are highly profitable companies, at least in the past, because what's a big game changer today is they are moving from asset light to asset heavy. Now a big question mark is, and it's been discussed publicly, of course, over how many years do you depreciate the data centers? Of course, the house building is maybe depreciated over 30 years, but the technology in it, it's going to be very difficult. Now, we are at such an extreme point that actually the current valuation do not really accept a lot of downgrades or disappointment. And on the next slide, it's also interesting, also from GMO, because GMO does these risk-reward charts since more than 40 years. And it was very interesting that they went back to see what was their risk-return chart back in the year 2000. And guess what? This chart looked extremely alike this one. And you see here in the circle below, US large equities are expected to give a negative return for the next 7 years, around 3%. And on the other hand, you have possibilities to diversify your portfolio into international small and mid caps. And international means ex-US. Or you could even diversify in international large caps, and you get, in the case of the international large caps, 4%. In the case of international small caps, basically 7%. And that is basically the case because these circles above are actually our fishing ground. And now if you look at our performance over the last 5.5 years on the next slide, you basically see something which surprised quite some people when I actually discussed this chart, because we were able basically since 5.5 years to beat MSCI World. We have two charts below. One is MSCI All Country and the other one is MSCI World. We're able to beat those two indices, let's say by 2 something percent. with only maximum 15% US weightings and nothing of the big seven. With an active share, meaning the deviation from the benchmark of 97%. How can that be? How is it possible? In my view, it's clearly possible because if everybody is focusing on the passive investment side, it leaves a lot of names aside, neglected, not followed, and that is basically our hunting ground. And we strongly believe this is not going to disappear. We currently have an expected return of 17.6%. It's moving up almost every day because of this risk and war that we see. And that is basically our conclusion. Please just don't look only at the index, because with an index product, you own 75% US large caps, which has been showing at a negative return for the next 7 years. And that puts back the mic to Marcos. Thanks a lot.
Thank you, Alex. I'm going to dive a little bit on the macro scenario that we always present in the quarterly updates, trying to talk a little bit about Iran. So we didn't change our scenario. You can see here that in 26, we were expecting a small acceleration in the US and in Europe, and this was presented in our call back in December. So we keep this scenario, just adding that now the war in Iran is gonna possibly create or may create an energy crisis and thus a risk of global recession. So now there's no really way or point to touch the estimates. Basically, we keep the scenario, and then what we say is that this is gonna be binary. Our base case is a short conflict, as I said, but it's 50% chances. Then just to refresh a little bit behind the war, the industrial production that we follow a lot because it's a good indicator and we have a lot of info from our companies. The industrial production was rebounding already. This is the chart from February, and then you see that the US and Europe are already above 50, China trying to get there. The stocking is over. For the past 2 years, we have seen a destocking cycle. And if you follow the news from the sectors, there's huge investments to come initially in a lot of sectors: technology, databases, infrastructures, energy supply, supply chains, defense, etc. So really, this CapEx cycle is taking shape, and it was starting to bottom out, as we said, but now we have the Iran risk, rounding around. So this is what can happen. I found this chart in Deutsche Bank research. It's very interesting. It's not really a causality chart. Basically, what they do is put two trends of inflation, the trend between 66 and 86, 20 years, including the embargo, the oil embargo in 1972, and you see the spike in the light blue, and then the revolution in Iran in the end of the 70s, and you see the other spike in blue. And now, in the dark blue, you see the spike in inflation we had in 2022 with Russia, and the potential upside in inflation that we can have if the Strait of Hormuz remains closed and we have an energy crisis. So this is, again, just to show a little bit what can happen if this war stays longer than expected. On China, nothing to say. It's not doing well. It is true that the data in January, February, because they always publish these 2 months together, it's a bit better than the December. So fixed assets investment up 2%, industrial production up 6%, consumption up 3%, which is good. But you see the chart. It's amazing how weak consumer confidence and property has been in the last 4 or 5 years. And we still not see a change here, so nothing new on China. Conclusion on the base case scenario is, okay, we keep our scenario of economic acceleration. Obviously, the war in Iran is a new black swan, which can derail the cycle, so there's a risk of recession, and it's the first time we see that for some time. And then we have these other worries that I can sum up in government deficits and debt. So this is a structural worry. The AI and technology valuation combination, which is our second concern, and then all these private equity and private credit and debt level, which is also a bit scary. But the message is our funds are ready. If the markets go up, the war is short, we'll make our return, we think, as we did for the past 15 years. And if the markets go down, we will buy, as we did in the last crisis. And I think we show it several times that after a crisis and a recession, normally markets go down 30, 35%, 25%. We probably will go down a bit lower because beta of the funds are going down. And then we will obviously invest the cash and turn the portfolios upside down. So let's move to the classic. So this presentation was meant to be a summary of 2025. I'm trying to add some color on what is going on. And basically last year was a good year. We did 12%. You know that our target is in the classic to make 10, 12% per year. So it's good. And this year we're up a little bit, 1, 2% in the last few days. The NAV is 770 euros per share, a little bit higher than our target. Best performing sectors last year: aerospace, defense, technology, electrical cables, and copper. You can see there the top gains, more than 20% in these names. And then the weakest sectors were catering, meal vouchers, salmon, some of the salmon producers, and oil. Oil last year was really kind of disappointing, and people were very negative. On the fund, we have updated our numbers. You know that we review all the models in December, January, February, when they publish the year-end results. The IRR now, as Alex was saying, is higher than 17%. Intrinsic value is close to 1,400. If I take these numbers, now that I have everything fresh in my mind, basically the target for 26 should be 890, which is well above the target we set in 2021, back in 21 with a 10% target long-term that you will see in a chart later on. Problem is here, okay, I say here that the target is 890. The problem is that we have Iran. So if Iran gets worse, we'll go to energy crisis, maybe recession, markets going down. So maybe this year the risk is to see a net asset value below our target, but we will see. And this is a question that I ask myself a lot, and I wanted to ask yourselves also is, what do you prefer? You prefer a falling market with falling net asset values that allow us to reinvest in cheap stocks and very possibly increase our IRRs and future gains? Or do you prefer rising markets in order to sleep much better? Honestly, personally, I think I prefer to sleep. But if you go to really the fundamentals, look at what Buffett was saying, right? He was saying, I would rather earn 12% per year with Vola than 10% without Vola. On the next slide, you can see the 10 top positions, and the message is always the same, but now is more valuable because you can see how diversified it is. And this is almost half of the fund. And most of the companies are global. Most of the companies are, good business models in our view, and with good management and good balance sheet. Obviously, there are cases such as, Grifols, where we can debate the balance sheet is here and there. But, overall, this portfolio is very resilient and it yields a very high IRR. So this is the message here is just be calm. We are calm, we are relaxed. If markets correct, we will do what we need to do. We just reversing the portfolio and buying at very, very interesting returns. So the guidance, it is the guidance that we released in 2021. We didn't touch it. We only put the real number in blue and the target is in orange. And you see that basically almost every year we've been very, very close to the guidance, which is not the normal thing. The normal thing is to have much more vol around this 10, 12% target. which means that this year, if things go wrong, we may be below or higher, but the long-term path, this 10% per year, we've been done for 15 years. We think we are going to repeat it. And this is the scenario when we say it's 17% return for the fund, we take out, approx some commissions and expenses, you go to a 15.5 expected IRR net of everything. So the orange case would be the best case scenario if our numbers are fully correct. Although, year on year, they are proving more consistent. The blue line is our target. So I guess, we think we should be able to be between the two lines in the next few years. And this just to repeat a little bit the performance. So you see the 15% I'm showing in the target here, and you see the 15% we've been doing since 2020. So something is meaningful here. And the interesting data here is the beta. Over the years, those that have been with us a lot of time, they know that the quality of the fund has been improving and improving. And this is shown in the beta, which is now non-adjusted is 0.7. If you adjust by the terminal, it's 0.8. So it's good to have a lower beta because in case of recession, the fund should behave correctly. You never know, but the fund should behave better than the market. I'm going to move to the investment case of this quarter, Viscofan, because I think it's an interesting case. So what happened in Viscofan, Viscofan, most of you know, it's a competitor of Devro. We used to be invested in Devro, and it's a sausage casing company. The sector is oligopolistic. There's 3-4 players globally with scale, and Viscofan is the leader. So we know the sector, we know the company, we know everything. And last year in October, some media outlet, Hunter Brook, they just published that they published allegations claiming that Viscofan plant in Danville in Illinois had really serious issues, toxic emissions, improper handling of waste, violations of environmental regulations, health impacts not only in the employees, also in the residents, and some breaches here and there in labor standards. So, the share price fell 20, more or less 20% very fast. And this is a case that we wanted to highlight because sometimes we explain the category 1 risk, category 2 risk. When do we buy them? We buy them when they have problems. So what happened is that we decided to talk to the company that we know very well. And they went, point by point, explaining us what was going on. Fine. They said that everything was either false or misleading. Then we had a second meeting with several US legal experts. You know very well that we pay some people to give us outside information. So in this case, it was legal lawyers. And we went also in a kind of long conversation, one by one, with the allegations. And they corroborated basically everything that Viscofan was saying. So we decided to buy because, we know the sector, we know the company. Once we think that the risks are controlled, we say, okay, this is a moment to buy. And now, a few months later, Viscofan is one of our top holdings, your top holdings. And we have an IRR of 13, 14%, price target 80. I think the stock is trading now at 58 or 59, something like this. And they recovered the 20% fall. So we bought really cheap here. Then they presented a strategic plan. This was in the beginning of this year that I'm going to go very fast because we don't have to go in detail. But this is a strategic plan that they presented for 2030, where they are, the two new businesses they set in the past 5 years, ingredients and packaging, and are going to be incorporated in food, in casings. And then they are launching 2 new businesses. One is health, so collagen for health, and then pet food or pet treats. And these, they say that the main division will grow, according to their estimates, 7-8% per year the next 5 years, with some contribution of the 2 new divisions that, if they are successful, will incorporate it to the main division, and where the risk is very small because now it's only 1% of the of the sales. So taking this and trying to sum up everything, what they say is that this is not a big company, it's a niche market. And we like very much niche markets with oligopolistic structures because they're not really that interesting for big guys. So they're less interested in competing. So they say they can reach 1.8 billion sales by 2030, which is an average growth of 8% per year. Very interesting. And increase margins a little bit, just 2-3 points, not massive. But this takes you to double-digit EPS growth with new technologies, some operating leverage, some diversification, some digitalization, and improving the sustainability of the company. And I apologize for the Spanish version of the slides because it's taken directly from the Capital Market Day. So net, we have a company with double-digit EPS growth, price earnings 2027 on consensus, which is, it's basically what we would have 15 times, return on equity 17 plus, price to book 2.4. So, we should be making, this 12, 13, 14% return in the next few years. And then changing completely the theme, we move to natural resources. And natural resources 2025, the 18%. So very happy with last year performance. I think it's the 5th year of very good performance, if I'm not wrong. And the net asset value very close to 200 already. Main winners, you see the list, but basically it's mining and some of the salmon farmers. And on the negative, last year was really bad for energy and oil, very, very mediocre in 2025. And surprise, we bought a lot of energy last year. And surprise, look at what is going on. So just to tell you that in mid-March, the fund is okay. It's 16% up in 3 months. I'm laughing because, 16% would be a nice target for the year end. The net asset value is 220. We also updated all the numbers. The IRR is 13%. Obviously, this IRR is on converged models. So, it's mid-cycle IRR. If we move to the upper part of the cycle, the performance or the returns should be much higher. But we are not really modeling on high cash flows and high level of commodities. We model everything on mid-cycle to really be flexible when we buy and we sell. And the convergence in value is still close to 300, is still way high from the 220 of the net asset value now. Main portfolio changes, an update for last year and this year. So as I said, in 25, we slowly and gradually, and with a lot of scare, we bought oil and gas with a lot of, returns above 15%, 16% in a lot of names. We reduced mining companies this year in 2026 because, as you recall, January and February were outstanding for mining and mainly copper. So we cut there a little bit or more than a little bit. And we bought some very high-quality companies. We like Barry Callebaut, a leader in cocoa intermediation, Viscofan, as I stated, and Wienerberger, which is an old friend, which is down a lot, and it's a brick producer and some construction materials. We know them very, very well, and we'll make good money here, we hope. And then we are entering in a new sector that is very attractive in our view, which is the electricity networks, so the grid lines. And we found 2 companies that we like, Southern Scottish Energy and E.ON in Germany. We bought these, and if the market goes down, probably this sector would be very interesting for us in the future with double-digit returns and more than a decade of growth. Core holdings. So here the main change from the previous structure of the fund or investments is that oil, adding gas and adding oil services already more than 40% of the fund, which is helping the performance. And on our numbers, it's going to help more. And then if you see copper is now below 10%, when it used to be much, much bigger. So we are out of copper, but it's more, short-term profit taking because long-term we are still super bullish in copper. And if we are lucky and we can buy them cheaper, we'll buy them cheaper. And then salmon is the third core investment. salmon farming. I will update you now in the next slides. And then you see a whole lot of other investments which are well diversified, no? From cocoa to electric grids, to bricks, to food casings, testing, electric cables, nickel, potash with Nutrien, iron ore, uranium. So the rest is very well diversified within the universe of commodities and natural resources. And you can see a list here of the core holdings. Although on natural resources, we have less weightings per stock because we like to manage it more on a basket basis because you have always intrinsic risks that we want to avoid. So you can see here Oxy, which is a US shale oil, Mowi, salmon, TGS, seismic, Barry Calvo, Cocoa, Viscofan, we already said, EOG, US shale, and you have here the list. So I'm going to take, I think this is my last part of the presentation. I'm going to speak about the three main positions of the fund: oil, then I will go to copper, and then on salmon. So on oil, as we said, this is the current situation. So in the left hand of the slide, you can see the exports that are down by, 14 million barrels. And on the right hand side, you can see the shut-ins. No, we have the two things: the Strait of Hormuz, which is now shut, and it's preventing 14 million barrels moving. And then you have really disruptions. No, so Iraq is the main country that has shut in production, around 4 million barrels, and then some others are there. And on our numbers now, you have 7 million, 7 million barrels a day are shutting. Again, sorry to repeat that. I'm not going to enter in the full detail of why we think it's going to be short, because it's going to be 50%. But our base case scenario is short conflict, limited damage to energy infrastructure. Although this is changing a little bit with the attack to Qatar, but I think we think it's still manageable. And a return to a normal level or reasonable normality, let's say in 2 to 3 quarters, or I would say more 1 to 2 quarters. Also, just let us say that our analysis is still very bullish on the oil sector long term. What is happening is that probably all these events are shortening the period where we had kind of inventories, excess inventories and excess supply. So probably the long cycle is going to be anticipated if this remains. And looking about the spare capacity in slide 36, you can see that the spare capacity now is around 3%, the effective one. So around 3 million barrels. This is going to go down with the war, which means that we are going to be very close of our 2%, 2 point something percent, which is where markets or prices start to move up, pricing in the tightness of the sector. No, so we have a lot of things that we have commented over time. Lack of spending for a decade, all these geopolitical risk. Then inventories are going to be consumed with the war of Iran. So it looks like that the upcycle is likely to be brought forward. On copper, so copper had a great couple of years in 25 and 26. Some of this has been caused by some shutdowns, which are short-term or mid-term, like Grasberg in Indonesia and Camoa in Congo, El Teniente in Chile, and Cobre Panama remains closed. So this has taken 700,000 tons offline, and this is more than 1 year of consumer load. So this has helped to the tightness of the market, and these tons will slowly come back. And this has pushed prices very high. Now spot is close to 6, although with the war and the uncertainty is a bit down now. And what is going on is basically nothing has changed. If you go to the next slide, this is our long-term scenario. Demand is accelerating from 500,000 tons to 1 million tons growth per year at the end of the decade. There's not really a lot of investment in new mines, in greenfields. And then our numbers suggest that the incentive price due to inflation in CapEx and in OpEx is probably around $5 per pound. So when copper moves above 5, let's say 6, as a couple of months ago, then we are above mid-cycle, no? And then scrap, scrap will help, but it cannot help really to stop the cycle. And I found this very interesting chart that summarizes our long-term view in hard-base minerals. So on the left-hand side, you can see the main problems: declining copper grades, not significant greenfields. The permitting is a hassle, inflation, etc. And obviously on the demand, there's a lot of new demand from electrification and even databases. So you can see in the chart that the market is already tight, but it will move to deficit in a couple of years. And what's important is that you see the dark blue and the light blue, which is the probable and the possible projects. And if you go to the next slide, in the 40, you can see these projects. And in the right-hand side column, you see a question mark or a cross when it's not clear that they are coming. And it's amazing. So most of them are big question marks. So Reko Diq in Pakistan, I can tell you, it's not even financed. Cobre Panama, very unclear, not yet resolved. Then Bainskaya in Russia, it's going to be difficult. So if you go one by one, all these projects have big question marks. So, all these probable and possible projects, I think they will take much more than what people expect. And lastly, on salmon, now more or less we have 20% of the fund, and also it's a big position in the classic. We were in Bergen in the conference as every year. So this is North Atlantic Salmon Conference. And, this is our main conclusions: good biological conditions, biomass. When I was there, it was 1% up, but in the last number that I received this morning, the biomass is down 1%. So supply is now, down. And demand remains very, very strong. In Asia, demand is growing double digit. In China, the same. So demand remains very, very resilient. Prices are already moving up. I think the last spot price is around 90 NOK per kilo, 7.5 euros. And the sector is cheap. I mean, let's go to 27, not to be that short-termist. And 27, it's 11 times. Historically, it was 14, 15. And in our view, it needs to be priced higher because we had a regime change or a regime shift a decade ago where the supply capacity in Norway and in Chile reached levels where really supply cannot really grow much more than, 1%, 2%. And finally, there's some consolidation in the sector. So we had a couple of deals. Cermaq bought from Greek Seafood, and Mowi has also bought. So there's some consolidation there, but it's difficult because it's a small sector. And this is a chart that I borrowed from Mowi, and you can see the expectations of supply growth on the right-hand side are 1 to 2% in the next 5 years. This is Mowi, but we agree with them. And then in blue, you see what has been the demand. You do a regression on fat prices, demand grows more or less 8%, let's say high single digit. So there's a mismatch between supply and demand. Prices should be higher. And, if you look at what is going on with the proteins, with the Strait of Hormuz, where fertilizers cannot go, these fertilizers and grains will probably see inflation. And salmon is super efficient in terms of consuming food. So it's one of the beneficiaries of higher food costs. But, this is kind of something extra. And on the risks, because we have very, very interesting investors that, they kick us with the risks and we like that. So we were there, in Bergen, checking with all the companies about these risks. The first one is offshore salmon. And it's really being, developed well below expectation. China has halted one of the 2 projects because it's not working well. And as you know, the projects in Norway, they are stopped. Most of them, just excluding one from SalMar. So it's really slow because, it's CapEx, needs regulation. It's not easy with the big waves and the biology suffers, so it takes time. We don't see offshore as a risk in the next 5 years at least. Onshore, as you say, they are building kind of facilities onshore, some of them close to the sea, in order to also to compete. But it's going to be also very difficult because you need the land, you need the permit, you need to invest, and then you need to manage the biological risk in closed tanks, which is not easy. And in the end, this will work over time, I guess, but we don't see scale in the next 5 to 10 years. And finally, China, which is very, very important to follow, because when China announces their intention to enter in a sector, you should be really worried about this. But what we learn is that they are focusing on building what is infrastructure, so the import logistics, the processing, value added, distribution, etc., storage, rather than developing, the raw material or the salmon. So we are a bit more relaxed on this, although we will watch it. Also, the offshore projects that we're doing, as I said, they are not really working well, and onshore will take a lot to develop, because we've seen that the Norwegians have started 5, 6 years ago, and they are still not really developing it. So it takes time, it takes a lot of time. And I think that's it for me. I will hand over to Urs. He will speak a bit more on the oil glut that everybody was expecting last year.
Thank you, Marcos. Alex, could you move to the next page? So I might have to disappoint you a bit in the audience, that if you believe that you will ever see $60 oil again, it won't happen never in your life, because $60 oil was not normal. And even $100 oil is actually very, very cheap. And I will explain that a bit in detail. But this is just the oil price the last 50 years. And let's be a bit generous. $60 was virtually the same price as 50 years ago. So how can people expect, in a world where obviously we have the whole development of money printing since 50 years, and check out just other prices. Take the DAX index, take the S&P, take a piece of land in Switzerland, the price for a beer, the price for a football ticket. I recently paid $150 Inter Milan against Bergamo on Saturday. So why should the oil price be the only price that stays the same forever, when everything else, being from asset prices to consumer prices, multiplied in the last 50 years? So on the next slide, I think that's a very good, obviously, slide to show this. This is the oil price adjusted for money supply, but you can also take other ratios. I recently showed the gold oil ratios and so on. What I think is very interesting, as you now have heard from Marcos, there are various comparisons now to the 70s. Maybe you stick to the other slide, Alex. I'll tell you when we should move on. And obviously then, where's the price level, let's say, where the demand is being destructed in oil, and then you will make the calculation, and the 70s. Or 1980, after the revolution and the war in Iran. But the very funny thing is, if you go on the homepage of the Federal Reserve, a funny institution anyway, because it's nor federal, neither has it any reserves. But back then, people in the central banks were very, very conservative, and a bit different to today. Because if you look at the speeches of Volcker and so, you didn't hear things about inflation is just being transitionary and these kind of things. It was back then when we said, now we have to break the inflation. Obviously, the debt levels in the world was very different, but Volcker took the interest rates up to 20%, obviously destroyed the money supply and broke the inflation. And now, today, we are in a different world. And we'll tell you soon, you will hear economists and very brainy central bankers, and they will tell you that obviously the rise in energy prices acts like an interest rate hike. And they will calculate, how much money is being drawn off the pockets of the consumers because of higher energy prices. And then they calculate this is the same like a interest rate increase. And they will come to the conclusion they will do a very different thing than in the 1980s. They won't bring up interest rates to 20%, but rather go on the other side. So meaning is a bit, in the 80s, who really broke it and who really destroyed the demand? Was it the oil price or was it the interest rate of 20%? Now you can say it was the oil price because of this, the interest rate went to 20%. So it's the chicken and egg question. But I can guarantee you it will be very, very different this time. And maybe on the next slide, Alex, I found this an interesting chart. It's in the commodity space, it's all correlated, and it's often the case, or always the case, that gold is a leading indicator because it smells the monetary development. Later comes energy, and then the food, as Marco explained. And technically, we see now signs that food inflation is breaking out on the upside. I know Marcus doesn't like technical analysis, but I can also explain this a bit why it is fundamentally the case. And you might be surprised, but did you know that the most energy intense sector in the world is actually the agri-food industry? So the estimates are that the agri-food, I'm not talking about agriculture, but the whole system, meaning inclusive processing and everything, the estimates are that it consumes 30% of all total available energy in the world is the agri-food systems. Half of it simplified fertilizers mainly and pesticides, and the rest is transportation and processing. So meaning if you're in the agribusiness and the food business, which I'm personally are, for example, in Australia, obviously you have to look at countries and say, okay, what is existing in these countries? Unfortunately, it's always Mother Earth that placed the things on the wrong end of the world in the wrong form. So countries are dry, other countries have water, cold countries, warm countries, countries with oceans, countries without oceans. And so you have to choose what you do. And maybe the idea to grow pineapples and bananas in Norway is probably not a very promising idea, but maybe on the fish side, it could be interesting because Norway is probably one of the most energy richest countries in the world. It has a 95% hydropower and obviously know about the oil and gas. So meaning the fish farms should actually be in a very good position in this context. And I would not really invest in an energy intense land-based fish farm in Florida when you have exploding energy prices. Maybe to the next slide, Alex. Maybe a bit of history on my personal experience regarding this situation now in the oil. And I will have to disappoint you that there won't be a quick drilling response for the situation we saw. First of all, we know about this shale industry. We have talked a lot about it. Never elsewhere in the world has it been possible to do such things like in the US. Because first, it's the geological situation, but also the access to capital, to know-how, etc. So you have virtually this drilling boom or this shale industry exactly where most money and know-how and so on is available in the whole world, which is actually Texas. And now what we see is that this availability of equipment is already moving out of the US. So the best rigs, the land-based rigs, they already are being deployed in Argentina, etc. So the US shale industry won't be replaced, or the same can be done elsewhere, and nor in the US because it's mature. And this is the forward curve in oil. And I can tell you a bit about my experience in a commodity bull market, 2000 till 2010. First, the same situation started like we see. So now, because of underinvestment, you got tight supply, prices are started to rise, and you got backwardation in the forward curve. And the problem is, it was the case until 2007. And everybody explained me, Urs, the markets are discounting that prices will go back down. And so it was always climbing wall of worry, the Chinese economy will break apart, and so on and so on. The problem is that the stocks, of course, discount the future oil prices, but the cash flows are real because they are on the spot level. In oil, it's virtually 6 months because that's the time frame until you get your petrol at the station. Meaning because you have backwardated market, the investments didn't happen and the response did not happen. And until 2007, virtually all commodities multiplied by 10. Nickel from 5 to 55,000, uranium from below 10 to above 100, oil, I think, from 12 to above 100. And after it multiplied by 10 in 2007, the big money of the world found out about the Chinese super cycle. And then they started to pour money into the CTAs and they started to bid up the back end of the curve. So they started to invest in commodity futures. And this meant we got into contango, but not because of a collapsing spot market, because forward prices moving above spot. And this was then the signal to invest, because everybody could calculate the project with higher prices. And this led to this huge investment boom we had from 2007 onwards. But as long as you have such a forward curve, it's not going to have a big reaction, because oil prices, they are at below 70 or at 70 in just a year or 2 years out. So they are not at 100, and oil companies cannot calculate with $120 or 100 when you have forward prices that are 50% below the spot price. Maybe to the next slide, Alex, and so I have to laugh a bit, but nobody could have seen this coming. But below was already the statements from Russia, that this is not ending well. And these stupid European utilities and politicians, they rely on the spot market. And we knew that you can't replace Russian gas. We knew it. By the way, did you know that Europe buys a lot of Russian gas, but not piped anymore, but LNG? And the LNG comes from the Yamal pipeline. And I wouldn't be surprised that it is branded as French gas, because the Yamal project is owned 60% by Novatek, and the Silk Road Fund and the Chinese oil company, and 20% by Total. So maybe that's the reason you can avoid the sanctions. But obviously now we are below. We are at 20% storage levels, and that becomes a problem because the pressure is gonna collapsing. And now on the next slide, maybe we can explain this a bit, Alex. This is the storage level in the European Union, and this problem was already visible in October, November. And if you, for example, check out the newest headlines from the meteorological front and the predictions for the Eastern holidays, there are two people which are very happy. The guys are being long ski resort, and the guys who are long, particularly Norwegian and Russian gas, because the Europeans will have to beg for Russian gas soon. And maybe something on the LNG, which is quite interesting. I don't know if anybody has in his winter home, for example, one of these huge American food centers, the fridges. My friend actually was surprised how much energy this fridge consumes, and he threw it away. And I just checked the food temperature guidelines from the US Health Department, and it shows the freezer should be below minus 18 degrees and the fridge below 4 degrees. Now, in Yamal, at the moment, it's minus 30. I think it's relatively cold, but I don't know, in Australia, Indonesia, or Qatar, it's probably not minus 30. But gas liquefies at minus 162 degrees, and it's being stored, LNG, at minus 160 degrees. So meaning this problem in itself creates a huge problem for LNG again, because LNG is a very energy-intense product. And not only is the price of gas going up, but energy will go up even more, because the process to liquefy it is energy intense in itself. And this problem is a structural problem. Iran is not the reason. Iran is just the fuse who lighted the fire. And as Marcos said, sometimes it's happening earlier, and otherwise it would have happened a bit later maybe. But Murphy's Law, but this is a structural issue, and we have explained this, I don't know how many times, about the underinvestment, etc., in this whole space, and it won't be solved quickly.
Thanks a lot, Urs. We have received 6 questions, so I go very fast over the last couple of slides. What we are looking for. We are looking for long-term partners that share our view and that really think like us. Maybe next slide, Marcos. The Net Resources Fund over the last 5 years has been ranked number 2 in Germany. We are happy with that, Marcos. In an ideal world, we should have, hopefully in 25 years, not only 120 years of investment experience, but 220 years. That's done by AI. So that is basically our usage of AI. And the next one, we have new share classes that we created last summer for institutional clients. They are here to the right. We'll send you the presentation afterwards anyhow, and you see them. They are at 1% in the case of the classic for no performance fee, and in the case of the net resources, there's still a performance fee. The next slide, please. We just want to advertise our two things coming up this summer and September. So we'll have our 5th Swiss Value Day on June 11th, and we will have the 9th Net Resources Day on September 10th. Next one, please. That's us, and now we should go to a Q&A. We have already received 6 questions, so I try to answer 2 of them quickly and then pass the remaining question to Marcos and Urs. How much cash do we have currently in our funds? It's basically 7% in the case of the classic, 4.5% in the case of the net resources fund. Another question came, how are we divided in the categories in the classic fund? We are at 37% in the classic in category 1, 39% in category 2. So combined, we are almost 3/4 in category 1s and 2s, and only 17% in category 3 and 4% in basically category 4. Now, there has been a question on AI, Marcos, basically stating, yes, I mean, AI valuations of the stocks are high, but don't we basically suffer through AI impact to the names in our portfolio so that they are actually going to be killed?
Well, that's the analysis that's the first thing we have been trying to do in the last few months. Basically, we went through sectors and we went through our stocks. And, natural resources fund is relatively easy to understand that the exposure is almost zero, or very close to zero. And in the classic, the exposure, maybe you can debate a little bit the exposure on some of the names, maybe Visa, but I doubt that is going to be affected. I think that on the contrary, Visa is probably going to use it in order to enhance their growth, because in the last conference call, they were saying that they're building AI agents in order to promote growth. So they're one of the leaders in this agentic work. And looking at the rest, meal vouchers are digital, but it's a network and it shouldn't be disrupted. And we don't have that many services that can be affected. So we don't have software, we don't have data providers, we don't have media. Media can be very much affected. So there is, 8, 9, 10 sectors we identify that are vulnerable, but we don't have exposure to them. And then it's really difficult because I was in a conference with the management of a company called Relex, the old Reed Elsevier. These guys, they have very, very, data, fantastic data in legal and in science and in medicine, and they provide this data to a specific clients. So doctors use the science data, then the lawyers use the legal data. The CEO was saying that AI would have zero influence in the company, zero in front of 100 people and in front of us. And then when you look at research and the sell side and AI especially, they say that they can be really affected by AI, not only, in a big way, but reducing entry barriers and maybe having an impact in prices. And then you see the stock market penalizing them a lot. The stock is down, easy 30 or 40%. So, there's a big debate there, but the really, I wanted to take a look and maybe buy it. And we decided to stay away until really we get grip on here. So, conclusion, we are not affected and we are going to stay away until we think we have grip. And we never have grip, we don't touch.
And it has to be cheap enough on top of that, exactly. There was another question on inflation impact because of less importance of oil relative to the 70s. Maybe just a short answer on that, Marcos, as well. on the recession risk?
Well, yeah, I mean, when I was looking at the chart of the 70s and the chart that published Deutsche Bank and this double-digit inflation, I don't think inflation will go to 10% as it did in 22, because in 22 was kind of unique due to the COVID. And the COVID really shut down a lot of sectors, which made that the supply couldn't react. Now there's a lot of ways in order to, so the world is working now normally, excluding Iran. So inflation can go, I don't know, 6-7% for some time. Also, it will depend on the energy crisis, right? But we don't think inflation is going to be double digit again as in the 70s. And then, you know, our base case is that this conflict is not taking more than a couple of months. So I don't think there is recession risk. Yes, there is high inflation. Let's put it high single-digit inflation for some time risk. Yes, our base case is that is not going to live much more than a quarter.
And compared to the 70s, what is really different that we are more gas dependent and LNG dependent than only oil dependent.
Another question for you, Urs, on uranium. How do you see the uranium market at the current stage? I mean, it was interesting to see that UBS came out with an ETF on uranium stocks 4 weeks ago. Pretty late in our view, but maybe Urs?
Yeah, man, it's a bit the hype sector, and so the stocks are extremely expensive, at least the Western one. The US has a horrible uranium sector, which is virtually not able to produce due to various reasons. So the only two companies which are available is Kazatomprom and Cameco. Cameco, I mean, it changed a bit, but I think a year ago I made a comparison to Glencore, which was very low back then. So both market caps were exactly the same, more or less. So just to compare, you know, Glencore made EBITDA of 2.5 billion in a bad year. Cameco a few hundred millions in a very good year. One company has 3,000 employees. The other has, I think, 200,000 employees. One company produces revenues of 3 billion. The other company, I think, 200 billion. So, but the market cap was the same. So it's due to this story, which is correct. You know, we will build more nuclear power plants, and it will obviously use more uraniums. But the stocks are just very, very expensive, at least the Western ones.
Thanks a lot, Marcos. There was Urs, there was another question on Pandora. Why Pandora? I would like to start and then pass on to Marcos at the end. I mean, Pandora is an old friend. It used to be basically trading extremely high before we bought it. Then it went from 1,010 krona to 510 krona. It halved basically because investors were saying this fashion thing with the bracelet is over, it's done. Now, why have we bought Pandora at this moment? The first time, because we have bought it several times already in the meantime, was Pandora owns their own factories with 13,000 employees in Thailand that are producing affordable luxury as a cost leader with no competitors at this price level. Now, the latest development has been that Pandora has been hammered again for increasing silver prices. And maybe, Marcos, you want to add a bit more on that?
Yeah, sure. Basically, so we were in Pandora for a long time, and we were right with the strategic analysis. So we make a very good return. And when the stock went back to normal, a couple of years ago from memory, then we reduced the weighting as we do always. I mean, when the stocks go up and they reach our targets, then we reduce position, but we kept a small position. And then we've seen that the stock has collapsed. It has collapsed because 50% of the cost is silver, more or less, gross figures. 50% of the cost of goods is silver, which means as silver, as you know, has multiplied by 4 or had multiplied by 4. And then, you know, the market has decided or has bet on a profit warning and then a change of business model and then whatever. So the stock is down from 1,200 Danish krona and the last is kind of 450. So it has divided more or less by 3. And we have been buying, we are buying, I don't know, from levels of 600, we started buying and we keep buying. Our reasoning is as follows. These guys have a very good business model because of what Alex was saying. It's a very good scale. So it's the leader. They produce more than 100 million pieces per year. So the level of cost is top in the sector. And it's very difficult to build this site. So it has cost advantage. It has also some IP advantage in the way of, so intellectual property in the way of how they design the jewelries, how they put them together, how they build the product. So there's some, a little bit, not massive industrial IP, I would say. And there's a little bit some other entry barriers. So we think that the business is very resilient. We think that the margins long term on this supply-demand equation should be 20-25% EBIT margin long term. And we think that silver will not be always at 100. So
And in addition, if I may interrupt, Marcos, there is no guarantee that the Pandora thing has to be out of silver 100%. It could be easily inside nickel and just outside silver finishing.
Yeah, so the company is doing a lot of things. So there's another event that was negative is that the CEO retired, and the CEO has been the one leading the company for the past 7-8 years, doing an excellent job. And what happened is that now the company will move a little more to platinum plating. So they will reduce the exposure to silver, which maybe, if we are very critical, we can say you should have it done before. You cannot depend on only one commodity. And they will diversify a little bit on other metals. But net, there's not a change in the structure of the sector. If there is no change in the supply side, there's no change on the demand side, basically costs will be passed. So it's a good example, and thanks for the question, because a good example of a strategic analysis. Costs in this sector are not the relevant factor, it's the competition. So the rest of the guys also have silver and gold, and basically the mix is similar, which means that the curve will move up and we will see inflation in prices. So in 2 to 3 years' time, we will sit here in a quarterly call and probably Pandora will be much higher.
Hey, thanks a lot to everybody. We are already at 1 hour and 7 minutes. We were really very, very pleased to have up to 100 people in our webinar today. Actually, Marco was even giving an interview on Bloomberg on Pandora. Maybe you'll find it there. Otherwise, we would look forward to welcome you to our Swiss Value Day and to our Natural Resources Day. Have a great weekend and have a great time. With best regards from Lachen. Bye-bye.